Hey all, welcome to ShareTreck. This is Raj here, friends. This is the third episode of our technical analysis course. And today I'm going to talk about what I know about RSI, which is Relative Strength Index, and how to use it, what it means, how it is calculated. Let's get started. Welcome back, friends. Philosophically, RSI basically is a ratio that shows you how often the market has been profitable in a period of 14 days as compared to it being loss making. So we are looking at the average profit divided by average loss for that period of 14 days, which stands to reason that if you got more profits during a given period than the losses, then you're going to get something above 50. And if you end up having more losses during a given a period of time than profits, then you're going to end up at something less than 50. Let me show you the formula for RSI. So here you see on the screen the formula for RSI. RSI is equal to 100 minus 100 divided by 1 plus RS. Now that 1 plus RS ensures that we have at least a number greater than 0 so that you don't come up with an error. RS is basically relative strength, and relative strength is average loss by average profit. So how do you make the average loss and average profit number? So take the 14 days period that you want to calculate the RSI for, and first of all scan it quickly and see how many days the market ended in profit and how many days the market ended in loss. So that is your bottom number. And then take the sum of all the profits divided by the number of days on which the market was profitable, you get the average profits. Likewise for loss, take the sum of all the losses and divided by the number of days in which the market ended in loss, that gives you your average loss. So relative strength is equal to average loss by average gain. That gives you a number, and this number you add to 1, and the whole thing is divided by and divide the 100 by that whole thing, and subtract it from 100, you get the RSI. But you don't have to remember all these formulas. You don't have to calculate it every time. All the trading platforms have a facility to just plug in an RSI. It does the computation on the run. It plots out the oscillator. The oscillator goes between 0 and 100 and moves around. So you don't have, the good thing is you don't have to calculate. But what you have to understand from this formula is that RSI gives you an idea whether the market is biased towards profits or biased towards loss. So from my personal perspective, the way I look at the RSI is that if the RSI is above 50, I'm happy because I can look forward to being able to make gains in trades more often than I would make losses, assuming that I pick a decent counter or a decent stock. And when the RSI is below 50, I think that the chances of me making a loss in any trade is going to be higher. So this is the by default, this is my wiring. But according to theory, you have upper range of 70% and a lower range of 30%. These are the two readings, 70 and 30. So if you come closer to 30, that means you are very close to the bottom. Typically on an average market, an average share, when it reaches 30, it's going to bounce back from 30 and move up again, which means the share will gain price because it's considered to be oversold. So as you approach 30, the stock gets oversold when you approach 30 on the RSI. When you approach 70 on the RSI, your stock is overbought, which means people are very excited about the stock. And they are buying, they are paying more, and they are buying, as a result of which the RSI is tending towards 70. As it approaches closer to 70, the standard understanding is that the moment you touch 70, you're going to start, the share price is going to start dropping because it was overbought, and people will sell it to cool off the RSI. However, in real life, things are a little different. Sometimes the stock can have an RSI above 70 for an extended period of time and also below 30 for an extended period of time. So for those kind of instances, what I generally do is I zoom out to a longer time period and I look at all the peaks on the RSI and I try to draw a line which connects the topmost, and it's always got to be a horizontal straight line. It cannot tilt. So I just draw a straight line, and wherever the highest level is, that's where I draw the line. And that could be 80% in some cases, 85% in some cases. Recently for NVIDIA, we had done that. We reached 83.5 or something like that. Now that line to me is the actual overbought line for NVIDIA in that particular case. That can change over a period of time, but in this hot market for that particular stock, I had seen that the RSI had touched that level before dropping multiple times. So that's the line I drew. But there is no hard and fast rule. It could even drop before 70. It could drop before touching the higher line of resistance on the RSI. This is my own understanding. This is my devices. This is how I look at it. Likewise, on the bottom below 30 also you can have a floor. It could be at 10 or 15 or something for weaker stocks, at which time it bounces back and comes up. So those are the mechanisms I have. But RSI alone does not give you the full story. You cannot rely on one indicator. In fact, it's very, very difficult to predict the market. Technical analysis by itself, even if you consider RSI and other factors, does not always succeed because there are other forces at work. There is geopolitics, there is macroeconomics, microeconomics, and there are rumors in the market. There's a short seller doing something, impending government policy. All those things distort the market. If Fed Chief Powell is going to talk, that's going to have its impact. So all those things are there. That said, if you look at the RSI, you also have to look at the price pattern. How is the price pattern? Is it in a bullish channel or is it in a bearish channel? That's another thing that you have to look at. You have to look at the next support. What is the next support that is available? What is the next resistance that is available? For example, let us say my RSI is around 60 and I'm in a bullish channel and my next resistance is maybe $5 or $6 away. Then I'm going to be looking positively at the price of that stock going up further because my RSI is above 50 and it's moving upward, and the price chart is also moving upward, and the next resistance is $5 or $6 away. Whereas on the other hand, if my RSI is below 50 and moving downward and I'm in a bear channel and I have got a support which is maybe $10 away, so there's a long way for it to go down. So I won't buy that stock at that time. And if I was holding that stock and I'm having a little bit of profit in it because I bought it long time ago, I might as well sell and take the profit. That's my decision-making process. That's how I use RSI in conjunction with the price pattern, whether it's on a bullish channel or a bearish channel or it's consolidating. What is the nearest resistance? What is the nearest support? When the share price is moving down, I always look for support. When the share price is moving up, I'm always looking for resistance that could block it. And in order to look forward to what's going to happen further ahead, you look at the trend of the RSI, which direction it is moving, and then you look at the trend of your prices, which direction they are moving. Look at where the supports are and where the resistance are, so that you know the range in which it is more likely to be there. But nothing is a given. These are all indicators, that's all. You cannot take it to the bank, but more often than not, you will have an opportunity to succeed using RSI, the trend lines, the bull channel, the bear channel, the resistance and the support, and the price patterns. And friends, in our next video, we're going to talk about chart patterns and see whether we can come up with some bullish chart patterns and some bearish chart patterns. And possibly we'll also talk about fixing price targets. So with that, my friends, I'd like to end this video. Please put your comments and questions below and I'll definitely answer them. I hope you enjoyed this session. Take care. Have a nice day. I'll catch up with you in the next video. Bye for now.